We just wanted to first thank everybody for joining us today on the webinar. I know looks like some people are still joining now, so we'll give it a couple of minutes before we really get into the major topics of discussion today. But obviously, merger and acquisition activity in the RIA and overall wealth management space is a hot topic these days, given the number of transactions occurring. So we wanted to share some insights just on what we're seeing in the overall market, as well as take some questions from any of you that are joining the webinar today. So you can ask questions using the Q&A function at the bottom of your screen. And we also have some questions that we've received ahead of time that we'll be addressing today. So some of you joining may know the team at Park Sutton Advisors, but for those of you who don't, Park Sutton Advisors is a boutique investment bank and merger and acquisition advisory firm focused exclusively on the wealth and asset management industry. So we're the most active investment bank for RIAs, having completed 15 transactions in 2020 and just announced our 17th of this year, with plans to close more than 20 before year end. So I'm John Eubanks. I'm a director with Park Sutton Advisors, and I'm joined by Dan Erickson, director at Park Sutton, as well as Stephen Levitt, who's the managing director and founding partner at Park Sutton Advisors. So I'll ask Dan and Steve to provide a quick background before we get started on the topic. Steve, you want to start?
Sure, happy to. Again, thanks so much for everyone joining us this Tuesday morning. I'm the founder of Park Sutton Advisors. We're in our 14th year. We're a team of 14 people based in New York. Our transactions are primarily in the financial services industry. And just given the incredible boom in RIA M&A occurring over the past year or two, that's where a lot of our deals have been. It's a mix. We tend to work with sellers, and maybe what I would just say, it's because the market's been so active, we wanted to offer our friends and colleagues around the industry some market update on what we're seeing and share our experience. I myself have been working in this sector now for 25 years.
Hi, everyone, and thanks again for joining today. Dan Erickson, I'm a director here. I've been working in this space for around 12, 13 years, always covering asset managers, wealth managers, global investment banks. Again, I've worked on tons and tons of transactions, particularly over the last couple of years. Market's been super, super busy. I think that we think that'll continue for the foreseeable future, and happy to have a discussion today.
So we were going to start with just a broad overview of sort of past, present, and future of M&A activity in the wealth management space, and then go on to some specific questions related to the current market environment. So Steve, if you could kick it off, you want to start with just sort of where things have been in the past and how they've evolved to where they are today, and having been in the industry for more than 25 years now. Your experience through various markets and peaks and troughs, I think, could be interesting just for the group to hear, your past experience and where you see things going from here. So how have deal economics changed overall over the last, 5 to 10 years?
Sure. What I would say is that maybe 10 years ago, most folks were interested in asset management deals more so than RIA or wealth management deals. There's been a huge shift. I would say wealth management is incredibly of interest. It's a seller's market. There is fervent buyer's interest. I would say, especially from 3 categories of groups, and that includes the private equity-backed RIAs, of whom there are quite a few and more, and that includes groups like Cerity and Hightower and Mariner, even Creative Planning. And then I would also say banks are very interested in wealth management. It's strategic to their businesses, fits nicely with their private banking and commercial banking, although they've been challenged to pay some of the prices that others have been able to pay. And then I would also say, well, maybe four categories. There's a universe of insurance and employee benefits groups who are very, very interested in the sector. And that includes groups like One Digital and SageView, who've bought clients of ours over the past year. Finally, I would say some years ago, if you were looking to raise permanent capital or private equity capital, there were limited options as a wealth manager, and now there really are a plethora of groups that includes folks like Emigrant Partners, Merchant, RIA Capital, among many others. So it's a very vibrant space. Maybe what I'll just add is really over the last year, valuation and deal terms have continued to escalate. I would say across the board, EBITDA multiples are way up, such that most of the firms we work with are receiving EBITDA multiples of adjusted EBITDA in the 10 to 15 times range, sometimes less, sometimes higher. I would also say much higher percentages are being paid at closing than in the past. In many cases, buyers are paying 80 or 90% down, which is a far cry from where it once was. Much of this is being driven by the private equity, low interest rates. Love the space, but let me stop there.
I think just adding on to Steve's comments there, what we're seeing today is just continued interest in high quality wealth management firms, continued push and multiples having increased over the last couple of years. At different points in time, the last couple of years, there have been, certain instances where it's the supply of, firms, quote, in the market has outweighed those of, the buyers in the market, and other times where there seem to be, a lot more buyers than there are available, good quality RIAs that are seeking a transaction. And so today, I think the tax environment toward the end of last year sort of accelerated a number of deals into last year and year end. And it, for a while toward the end of last year, it seemed like there was a surplus of firms coming to market. And then, coming into this year, things turned around. And again, there were just a significant number of buyers, including these private equity groups, the insurers, banks, national branded RIAs, as well as the, strategic kind of roll up or aggregator firms. So beginning of this year, activity, picked up again coming out of last year, and we saw toward the third quarter increase again in an interest of getting transactions done by sellers before the end of this year, which ultimately accelerated the number of firms that were coming to market. And so for the first time in probably 3 or 4 years, we started to see a bit of a softening in the market where, the number of firms coming to market seemed to be significant compared to prior years. And some buyers have had a lot going on and a lot of deals to look at and review, which has sort of seemed to create this little bit of a softness in the market. But that said, there are still, valuations are still elevated, number of transactions occurring are still at all-time highs. And I think where we are today is sort of, a high point over the last 2 years for sure. And so a lot of things can, of course, impact where we go from here, but I'll let Dan speak a little bit to kind of the next 12, 24 months and where we see things going from here. So Dan, I guess one of the questions for you is, having seen this kind of market boom over the last couple of years, what are your thoughts on the next 12 to 24 months as far as a general M&A outlook and what happens from here?
Yeah, sure. And I think if for those of you who have joined before, you've probably heard us say this. I think in general, we think we're going to be busy for at least the next 5 years, if not 10. While many deals have likely been pushed forward this year due to potential tax changes, this is still a fundamentally consolidating space, and with valuations where they are right now, it's really, really difficult for founders and owners to solve for succession internally. We see firms that are doing this, they're very often offering significant discounts to next gen, so many are looking for external partners. as John mentioned, what we've seen this year, I mean, it's not too dissimilar from what we saw last year. Everyone wanted their deal done yesterday. Everyone wants the deal done before the end of 2021. Even with some of the new news about potential capital gains taxes not being as high as once was thought, it's, perhaps not 40+%, but maybe it's 25%. None of our clients are putting any less pressure on us to get the deals done this year. But again, valuations are so high for firms right now that it's hard to believe that they would go up from here. But again, one never knows. We'll do over 20 deals this year, and at this point, while not all have closed, we have final offers on largely all of them, and we've looked at this graphically. And if you were to plot this on a graph, what you'd see is, regardless of deal size, the multiple has probably gone up a point or more from even the start of 2021, regardless of deal size. So I think we found this to be super interesting. I mean, we have one of our highest priced deals for the year right now, and it's a firm that has under 800 million in assets under management. So we'll see what happens with interest rates and equity markets. There's a lot of private equity money sloshing around the wealth space, as Steve alluded to. Just a lot of interest in the space in general. I think if fears over tax increases subside next year, perhaps there are fewer sellers coming to market, and maybe that even helps support valuations for longer.
So we've got some questions, as I mentioned, that were sent to us ahead of time that we're going to cover here in just a second. If anybody does have questions, you can ask those through the Q&A function at the bottom of your webinar screen. But just to start with some of these background questions, one would be for Steve. Given the upward market trend we've been in and where we are today, what historically has happened during past recessions with regard to wealth management and RIA M&A, and could that play out similarly the next time around that there's another market downturn?
Yeah, I mean, I think what I would say is at least the last material recession that comes to mind is the great financial crisis. And, that was in 2008, 2009, 2010. That was before this prior 10-year boom I was describing before, where there's just incredible interest to acquire, consolidate, roll up wealth managers. But I think that what can tend to happen in general is during a correction, that if buyers are going to expect there to be just a decline in valuation and lesser deal terms, you're looking at sellers just deciding to wait and not to proceed with their transactions. Now, it could be the case that if you really have a prolonged recession and you have sellers who just really need to do a deal for whatever reason, they need to go ahead. But that could really slow things down somewhat, I would say, in terms of the activity. But one thing I'll comment on in relation to the graph Dan was alluding to before, which showed on the Park Sudden deals, just multiples all along the year going up, irrespective of deal size. That's just surprising. It's really not what one would expect. You would think that there would be more differentiation for quality or size or growth characteristics or geography, for instance. So, it's hard to say. We ask a lot of people what they think will happen over the next few years. Again, I think as Dan and John have mentioned, we do expect there to be, in general, fairly active continued activity. Remains to be seen, though, as some of this consolidation goes on, if there may be more of a pricing dichotomy, as the buyers are willing to pay the top multiples for the stronger properties versus everyone, which just seems to be a little bit across the board right now.
So we've received a few questions as you were talking, and I think one of these is important to go ahead and address. And that question is, what distinctions are we using to define differences between asset management firms and wealth managers? So I would say, in our mind, that the asset management firms are typically those that are serving as a third-party money manager or intermediary for other advisors. So those may be people that are running, individual equity, individual fixed income strategies that are sitting on platforms at Morgan Stanley, Merrill Lynch, Raymond James, the regional and national wirehouses. Whereas, the traditional wealth manager would be those that are really directly serving the end high net worth or affluent client, and really doesn't, not serving as an intermediary between another advisor and the end client. So regardless if someone is, an active manager, passive manager, or philosophy is, using funds versus ETFs or individual equities, as long as that firm is really serving the end client, regardless of how they're managing that money, those are the firms that we would consider, the traditional wealth managers. So moving on to the next question in here. The question is, and I'll ask this of Dan, can you speak to the range of outcomes or exits? And I assume that this is asking about valuation ranges, and also providing some anecdotal examples of how principals are exiting or whether they are exiting at all at the time of a sale or, exiting further down the road. So maybe Dan, could you just speak high level to, what we see happening as founders or principals go through a transaction, how long they typically stay on board, and if there is, a kind of sweet spot or time frame that they would be expected to stay?
Yeah, sure. I think for many, it's more of a next chapter than it is an exit. I mean, sometimes if firms and founders have done a really nice job diversifying the client base amidst the various advisors that they have, maybe they're around for a shorter period of time, or maybe they move into a strictly business development capacity because we worked with a firm last year that the founder, they were so delighted with the group that they ended up transacting with, that they wanted to stay around in a business development capacity, and the original plan had been for them to sort of sail off into the sunset. But for many groups, acquirers, they want founders, they want owners to stay around. They want to make sure that the relationships stay post deal. Usually people aren't being offered very, very long employment contracts though, but 2 years, 3 years could be typical for a founder and owner to stay around post deal. It could be less, and again, it depends what type of diversification the founders have done in the client base ahead of that planned transaction. So John, what did I miss there? Was there more to that question?
I think you covered most of it, and I would just add to that a lot of the decision to for the time to stay really depends on each individual owner or partner's own goals and objectives. And certainly there are people who sell and leave within a 12-month period. There are people who sell and are still there 15 years later with the acquiring firm. And so the range of outcomes there is pretty wide, and it's really often driven just by the goals and objectives of the seller, as well as what the various buyers are interested in, or how short of a timeline they're willing to work with.
That's a really good point.
And so
clients that they transacted 10 years ago, they're still there today. And I will mention, I don't think there's ever been a client that we worked with that after the transaction said they work harder than they did before the transaction.
I have a former client who every year, I won't say whether this is a he or she, but every year they complain a bit that they sold, and yes, they made a lot of money, but they're not as important internally as they once were. But then as they're complaining to me, they also share how much they continue to make. This is 8-10 years after the transaction. They work about 2 hours a day. Life is pretty great. they always kind of thank me that, it sort of helped them realize that actually this was pretty good. Look, when you do a deal, things change. You're not the owner. Everything is not the same as before. But I think for a lot of sellers, as Dan said, you tend to be able to get leverage and focus more on the aspects of the business that you really like. And if you vet carefully the different buyers, you're also able to link up with someone where you just have you see life the same way. There's a good vibe, and presumably it's a larger platform who is investing in the business, and therefore, maybe on your own you would have to hire a head of digital marketing or social media or a COO and internal recruiters, and you don't have to do that if you join the right partner. Let me ask one question. I'd just love you two to comment, because sometimes prospects ask us, John and Dan, tell them about the deals that haven't gone well. So I know that we always do try to stay in touch with clients to hear how it's going, but what's your response to that when people say, well, some of these must not go well?
Yeah, I'll take the first part of that. I think that this speaks to everything we've said so far. Really speaks to the importance of sellers vetting buyers and buyers vetting sellers, and the process that you really need to go through of understanding who the potential partner or partners are that you're talking with. Goes for both buyers and sellers. And so if you take the time to really get to know the groups that you're in discussions with and talk to multiple groups to make sure that you are in fact, understanding what the landscape is of potential partners and able to make the best decision at the end of that, I think there's a much lesser chance of, things not working out well. I would say personally, in the deals that I have seen that seemed to have, some issues post-close are typically when decisions are made very quickly without really going through to take the time to ask the questions that should have been asked and make sure that they're fully understanding the overlaps and the differences in various firms that they're talking to. So I would say a lot of it goes back to just making sure that up front, before the decision is made, that sellers and buyers both take the time to understand each other's firms, philosophies, culture, and everything else that goes with making a partnership work. Dan, I don't know if you have anything to add.
I don't. I mean, I will just comment on one thing though. We had, I think, 4 deals last year close where buyer and seller never met. This was all done over Zoom. Now, in our processes now, we're generally running first meetings over Zoom, but now with travel opening up and things presumably getting better, second round meetings are being done in person. But I think a client of Steve's actually made a comment to him that doing these meetings over Zoom, he had to pay extra special attention to ask very good questions in these meetings because he knew he wasn't going to be able to look them in the eye, sit across the table from them. So I think it made them really do their diligence and make sure that, let me make sure I better get the important questions answered. Because otherwise, this could end up not too well a couple years down the road.
So we've got some additional questions coming in, and I'll try to group these into categories so that we're not jumping all over the place and kind of covering each different topic together. So one of the next questions is, can you please discuss the level of interest by permanent capital, minority interest buyers in the marketplace today? So Steve, you touched on that briefly a minute ago, so I'll throw that back to you to go into a little more detail there.
From permanent capital and or private equity? I think,
yes,
please.
Yeah, can you please discuss the level of interest by permanent capital, minority interest buyers in the marketplace today? So just overall permanent capital, minority interest acquirers, what does that level of interest look like, and how many of those deals are occurring?
I think there is tremendous interest by financial investors, permanent capital, and private equity to put capital into the space. Over the last 12 months, we ourselves have closed 2 deals where minority investors made investments. One was Verdant's Capital Advisors, $3.5 billion, Hunt Valley, Maryland. Another one, Madeira Wealth Management, about $6 billion out of northern New Jersey. I think there's tremendous interest. I think that the interest in many cases behind permanent capital is families, family offices, who very much like the characteristics of wealth management business, the fairly steady cash flows. And I think when they look out at their opportunity set in terms of where they can invest and get yield, this is one that comes up as being very attractive. It's a consolidating industry. There's scale that can be achieved by putting firms together. It's very notable when you look out at firms like Allworth, EP Wealth Advisors. Those are 2 that just come to mind. They took in minority investors in the last several years, and they've really taken off. Carson is another one. I can't remember where they did their first deal. It was under a $200 million valuation, and the last one with Bain Capital was at $1 billion valuation. So I think very, very active. I mean, we ourselves are currently in the market with an $8 billion platform firm, very fast growing. We think we're receiving very strong interest from private equity investors.
So adding a little bit more around that before we move into some of the specific valuation questions, Dan, what would you say about just aside from the permanent capital and sort of general minority stakes, what would you say about private equity backers in this current market and how private equity is really viewing the wealth management landscape, as well as, where PE is as buyers in this overall landscape versus historical years?
I think, and Steve mentioned this before, private equity really, really likes this space. There's a lot of dry powder. I think this is across the board. They like these firms that have steady margins, steady revenue streams. They're high ROE businesses. The revenue is largely predictable outside of the large market corrections. And even throughout the pandemic, perhaps these RIAs had a quarter or 2 where revenue was down, but across the country, there's businesses failing all over. So I think most of these firms have paid back their PPP loans. So if anything, it's sort of shown a light on this space. So again, PE really likes this space. Interest rates are low. We continue to see very competitive offers from PE sponsor-backed RIAs. So like some of the ones that Steve mentioned earlier. So just to mention a couple of the firms that are PE backed, as some of the viewers might not know, but Wealth Enhancement Group has 2 PE backers, TA Associates and Onyx. Mercer Advisors has Genstar and Oak Hill as PE backers. Charity Partners has Lightyear Capital as a PE backer. That's the PE firm that was started by Don Marin of Payne Weber. Mariner Wealth Advisors sold a stake to Leonard Green. That's a private equity firm that's well known, not necessarily for the financial services space, more in consumer, but that stake was sold at, presumably a very high multiple. So a lot of interest in this space, and again, these PE-backed firms, they're competitive in their offers, and I think having a capital partner is critical. And even for Steve mentioned we worked with Verdant's Capital Advisors. They didn't sell to private equity, but they sold to permanent capital, and they wanted to have not just the capital resources, but also the know-how of somebody like an Immigrant Partners, so that they can participate in these types of transactions.
Yeah, you also see some of these groups sell a stake and then they're having a recap a few years later. We see that with a lot of the groups that Dan has just mentioned. A couple of groups that come to mind, very interesting. Savant is a very successful wealth manager in Illinois, about 12 billion under management. They had some family office investors and recently reported the sale of a stake to Kelso at what we believe to be a very strong valuation. And Wealth Partners, the firm EP Wealth Advisors, the firm in California I mentioned before, we worked with them when they were 3 billion, and today they're, I don't know if they're 12 or 13 billion. And in the past year, they sold a stake to Berkshire Partners, which is, again, putting much more significant amounts of capital to work. So private equity is all over this space. We're often seeing now recaps after a number of years, and the RIAs are getting bigger and bigger. Someone reminded me over the weekend that perhaps it may have been, I don't know, but maybe United Capital selling to Goldman a couple years ago really just validated how wonderful this space is, and we're just seeing this boom and activity and expect to continue to.
Last thing I'll mention too is the way that many RIAs are bombarded with calls from buyers or investment banks like us, and that's the way that we are bombarded by calls from private equity firms that are looking for a platform in this space.
Yeah, it seems like, everybody we talk to these days is getting, daily, weekly emails, phone calls from acquirers and various groups throughout the country. So I think it speaks to just the total activity as well as the interest from a lot of these different groups. Moving on to some general valuation questions. One of the questions that was just raised is, generally speaking, how important is the purchase price as a factor in an RIA seller selecting a buyer? And does that generally supersede cultural alignment? So I think I'll take this one. And I think that, pricing is certainly important. And I think probably some of the buyers that are on the call today may not like what they hear from us related to this particular topic. But the fact is that sellers often have multiple options, and sellers often have the feeling of a cultural alignment with more than one of those buyers. And so if cultural alignment and overall client service philosophy and a lot of other important factors all align, then valuation is extremely important. And years ago, when the market was not as robust as it is today, maybe that was slightly different. But today you have to consider that every buyer is getting, or every seller is getting calls left and right. Like we mentioned, they're getting emails left and right from every type of potential acquirer that exists. And so, of course, they're going to find, in many cases, if they have conversations with multiple buyers, they're going to find a cultural fit with more than one, sometimes more than two. And so pricing is going to be extremely important in this market. So I wouldn't say that pricing supersedes cultural alignment, but I would say that in this environment, cultural alignment we are seeing occurring, with the clients we represent, often with more than one buyer. So if we move,
just to add to that, I would just say, look, while it is a seller's market in this sector, now I still tell clients and prospects, it's still buyers kicking and screaming, getting them to pay up or where we want them to go. So it also doesn't mean buyers are just prepared to throw out these, lofty valuation and deal terms just because. You still kind of have to get them there. But look, valuation is very important. I would say a lot of our clients, if not most of them, often do not go with the highest bidder. Are they going to go with someone who's 30% lower? Probably not. But usually, look, if it reaches a point where we're selling currently a $4 billion multifamily office, they did not go with the highest bidder. They figured out where they thought the best fit was. They were really down to 2 or 3 they most seriously considered, and then there was one they liked the best, and their offer wasn't the highest, but it was in the range. Maybe John, something else interesting to comment on is talk about just what we're seeing, how buyers value synergies in these pro forma EBITDAs or not. I think that would be good for our audience.
Yeah, I would say in the past, one of the big things that has progressed over time, and certainly has been a gradual change, I guess, until recent years, is whether or not, buyers will price their acquisitions based on proposed synergies that exist. And so what we mean by that is things like technology, compliance, accounting, operational functions. So there's obviously a lot of back office type functions that a smaller RIA may have, and the acquirer is, of course, already going to have in place. And so when that acquisition is made, by default, a lot of those functions may go away, some immediately, some are eliminated over time. And historically, buyers were not willing to pay on those, future synergistic cost reductions. But given the competitiveness in the market today, they are, because it's they are actually real cost savings. It's not just numbers that are pulled out of thin air. These are true synergistic costs that go away in a merger. And so now we do see buyers almost always paying on these synergistic cost savings on a pro forma basis. So moving on to some of the specific questions around valuations, Dan, I'll give you this next question, and that is, how much are higher valuations being driven by a bidding frenzy versus just fundamental strength?
I think it's both. So Steve sort of mentioned this before. I mean, no one wants to pay a dollar more than they have to. We always advocate for our clients, please speak with more than one group. A competitive dynamic is important. Even if you like one group, or you think you like one group, maybe you find out speaking with others that you don't, you like somebody else more. But I think that competitive dynamic is important to driving valuation. So that's certainly key. But look, growth is king. If your firm is growing, you are absolutely going to get a better multiple than somebody that's not. Now, that doesn't mean that the firm that's not growing in this market isn't also going to get a very, very competitive multiple. It just means that it's not going to be quite as competitive as somebody who's bringing in double-digit organic growth every year. So not market growth, but organic growth. Other things about the business, I mean, client concentrations. Are clients of the firm, or are they really tied to the individual advisor? If that advisor left, could they take the clients with them? Geography is important. That's something that can drive pricing. Now, I think what's interesting in this market is it seems like acquirers, they want to have a beachhead everywhere. They're interested to buy all over the US. Now, I would say some markets in particular that probably we've noticed garner a bit of a higher valuation would be Texas, Florida. Those are probably the two top ones that I would say. Florida in particular seems to be very challenging for deals to get done, and at least with RIAs that are of significant size. I'm not talking about the ones that are just a couple $100 million in assets under management. Perhaps that's a little bit easier. There just aren't that many of them. So I think it's, I mean, again, it's short. People are absolutely looking at the characteristics of the business. And again, growth is number one, I would say, but the competitive dynamic is super, super important.
And Dan's raised an interesting point I'll just mention, which is, it used to be buyers wanted to be in, before, I would say maybe over 5 years ago, major metro markets, but they really wanted to be in the center city. They didn't want to be in the suburbs of Boston or as much in New Jersey even. And I remember thinking, like, this is ridiculous. Well, why wouldn't someone like to do a deal with a really good firm in Morristown, which is 40 minutes from Manhattan, just because of the tunnel traffic? But what's really, but that's kind of how it was. I remember working on deals and no, I don't want to be there. They need to be in Midtown Manhattan. But this has really changed. As Dan said, a lot of these large RIAs, they want to be everywhere. And it's amazing when we ourselves reach out to firms in all of these different geographies in rural parts of the country. These firms have all been touched. They've received offers. Everyone is being called on. So it's just really amazing.
Yeah, I would say if you further unpack that into kind of three categories that are firm specific characteristics, industry specific, and situational. So the firm specific would be those things that Dan mentioned, like growth. You know, how quickly is the firm growing? Is there a strong second generation team in place? What's the service offering? Average client size, average client age? All those things would be firm specific. And then industry specific, I think, to this question particularly is where maybe some of the fundamental side of it comes in. And that goes back to an earlier part of this conversation where we were discussing just the structural changes in the wealth management industry overall. You know, the need for succession for partners that are looking to retire or exit, the increase of technology and the need to create further scale to continue to compete regionally and nationally is important. That's been a driver of M&A activity. And then the third, situational, could be a number of things. That could be specifically geography. So, is this firm located in a really attractive market that is of particular interest to a particular buyer or a handful of particular buyers? And so all of those things kind of work together to drive, valuations in a specific firm. But I think that the question is really, whether it's fundamental or firm specific. I think the answer is both, but the activity today has been driven a lot by the underlying structural changes occurring in the wealth management industry, which has led to this kind of frenzy, which has driven up multiples. And then within that multiple range, those other categories are really what push one toward the top end or one toward the lower end of what a normal range might be. So looking at some of these other questions, I think we wanted to try to keep this webinar to 45 minutes if we could, just to be respectful of everyone's time. But I know there are a number of questions we haven't addressed yet. So I think real quickly, Dan, for you, since you talked about this a little bit in the very first question, as far as where things go from here, are there any other pitfalls that might slow strong M&A activity other than a recession or a market downturn?
I think the big thing in question right now is interest rates, because if debt becomes more expensive, then these sponsor-backed RIAs that are, to a large extent, keeping the market super competitive, it becomes more expensive for them to do deals. And I think that's probably the number one thing that we've discussed at Park Sutton that could cause valuations to compress.
So one more question that's I think an easy question to answer is, how does key man risk impact valuation? I think this goes back to, looking at firm specific characteristics. So Steve, can you take that one?
I think it does. Look, I think that when one is buying a wealth manager, they're buying recurring cash flows. What matters is the growth, as you heard already. What also really matters is that clients are clients of the firm, and one is paying for cash flow and relationships, which if client attrition is 2 or 3% a year or less, that means those clients should be sticking around 25 years or something like that on average. And I think it really does matter that there be a team, there be some next gen bench strength. Now, all of that said, what is interesting is just in this market boom, this just is a market where, because it's such a seller's market, buyers are very much willing to overlook shortcomings that they would not have been so forgiving about 3 or 5 years ago. So it does matter. Key man risk makes a difference. A firm, all else equal, is less attractive than one that doesn't have that. But still, I don't know, everyone we're working with is getting quite a few offers in this environment.
John,
So I think one final.
If we're going to do more questions, I
ahead.
want to mention one more thing before we close, but go ahead.
Yeah, there was one final question we had that I thought makes sense to close on, because it relates to, the buyer versus seller market and kind of what we see over the coming years. So any comments that you want to make, I think go ahead and mention those, and then we'll move on to the final question.
Steve, you want to take this one?
My quick comments that I can think of off the cuff. Number one, thank you to the audience so much for joining. I mean, we really have gotten a very strong turnout today and flooded with questions, more than usual. And it really, to me, speaks to, I think, the fact that folks are aware of the boom in this market, and people are paying attention and interested. So I mentioned that. Also, very quickly, I just want to say, as we were talking about private equity before, something you should think about, you can talk with us, talk with others, is there's a very interesting opportunity that exists by doing a deal with one of these large RIAs backed by private equity. It's not only that you have an opportunity to join a national player or offload the stuff you don't like, but essentially these private equity firms behind the large RIAs, they're pretty much all looking to return 3 times their invested capital over 5 years. So let's say your firm's worth 20 million, you decide to take 5 million in equity. Very good chance if you pick one of these groups, they're all these blue chip PE, that 5 million is very likely a tax-free exchange and could be worth 15 million over 5 years. So it means your business, which might have been worth 20, you really could be taking 30. So it's just a really interesting opportunity to consider. And then last thing I'm just going to say, Park Sutton's growing. If folks know talent, I'm sure everyone in the market is looking, and there's a talent shortage. We're looking for great people, producers. Think of us. Anyway, sorry, back to you guys.
Last comment, John, is I think it's, I don't know we touched too in depth on this piece, but folks often want to hear about valuations, deal structures, where are things now, how have they changed? I mean, so just to speak a little bit more on that, if we had been having this conversation 2 years ago, when I used to speak with folks, I would tell them, you can kind of look at valuations in 3 buckets. If you're, and this is, I'm generalizing a bit, but if you're 200 to 500 million in assets under management, maybe you would get 5 to 7 times EBITDA. If you were 500 million to 2 billion, maybe you would get 7 to 10 times. And then above 2 billion, you could start seeing these double-digit multiples. That is so far from where we are today. Now, if you have 500 million in assets, unless there's something really wrong with your firm or there are legal issues or something like that, if your business is halfway decent, you're probably going to get 10 times on an adjusted EBITDA. And then it just scales upward from there. The other things I would mention are deal structure, very seller favorable. So we see top offers right now in this market, 80 to 90% paid at close. Earnout periods are generally 2 to 3 years or less. We've had a couple that were 1 year, but I would say 2 years is pretty common. In the past, it might have been 3 to 5 years, and a significant portion of that might have been, a significant portion of the earnout might have been based on your having to achieve a fairly significant growth rate. In these sort of 2, 3, 1 year earnouts that I'm talking about, a lot of it is just linked to retention now. So just keep the clients and you'll get those contingent payments. So again, very seller favorable market. Interesting time for folks that are considering to do something. And again, I'll mention, we sort of sound like used car salesmen when we mention this stuff and we joke about it, but this is just what's happening right now.
Which is why it kind of makes you wonder and question, is this a peak? But it's just the market right now.
And I would say, kind of to wrap all this up, this final question makes a lot of sense in the context of all this. And the question is, many people talk about how we've been in a seller's market for the last few years. Is there a buyer's market on the horizon? And I think that, as I mentioned early on, that for the first time in a number of years, we have been seeing buyers that are getting a little bit of a bottleneck with regard to the total number of transactions that they are looking at right now. And so it's not changed deal terms or changed valuations to this point, but there is some glimmer of that sort of on the horizon. The real question is whether that is solely due to the influx of firms coming to market because they wanted to close a transaction before year end, or if it is more structurally related just to the number of firms that will be coming to market, in the near term. And I think our belief there is that it's temporary, through the end of this year, just given where we are with the number of deals. A lot of deals will close December 31st across the board. There will be a significant number of transactions that take place in this fourth quarter. So I think we believe kind of structurally from an underlying standpoint, there will continue to be a seller's market for a number of years as these firms sort of continue to work out structural issues and needs for just general succession. But again, we want to tell everybody we appreciate you taking the time today. We did receive a number of questions that we didn't touch on related specifically to how investment bankers get involved in these transactions, what a process looks like. To the extent that you have those questions, we're always happy to answer those one-on-one. Feel free to reach out to any one of us, and we're always happy to talk about those things. So again, we appreciate the time and on this Tuesday afternoon, and appreciate everybody taking the time out of their day. Thank you.
Thank you so much.